saw Bitcoin being that same wild child that it's been, that many of us know and love, going all the way back to the days that I traded my first Bitcoins in 2013, 6 out of the last 6 years, on which we have identifiable, statistically robust data on Bitcoin derivatives markets. We have seen a significant upswing in Bitcoin implied and realized volatility into the fourth quarter. Why is this? Well, I think that's part of the recipe of the secret sauce of vol traders the world over, but suffice it to say that that is in the data. And once again in 2025, that proved to be the case. Will history repeat, or will it merely rhyme this year in 2026? We shall see. If you believe that Bitcoin is global digital capital, and I believe today more than ever, Bitcoin is doing amazing stuff. I still say today, as a former precious metals player, take your gold bars and go trade an over-the-counter options contract on gold and show up with your bars and post them to your friendly FCM and say, hey guys, I don't want to post cash margin, just take my gold. They're going to tell you, dude, take a hike. Doesn't work that way. You still need the good old US dollar per Uncle Sam's requirements. Bitcoin is almost the only asset in the world where you can show up and trade a derivatives contract and just straight line that Bitcoin into the collateral for the contract, settle the premiums in the asset, sweep it back to you, and do the whole thing in this native unit.
Hey everybody, Tyler Rowe here with the Bitcoin Treasuries.net podcast. I'm here with Gordon Grant, who's a 2006 graduate of Princeton University. He's been substantially involved in the digital asset space since 2013 as a crypto investor, entrepreneur, and thought leader. From 2021 to 2023, he built the regulated derivatives trading for top dealers, serving the industry's largest hedge funds, investment firms, protocol founders, and whales. Gordon Grant is now at Bitwise as portfolio manager and head of derivatives. Welcome to the show, Gordon.
Hey, great to be here. Thanks for blocking the time. Just coming off of Strategy World, at the turn of the last month in the quarter. We got a lot to talk about today, so let's kick it off.
Lots to talk about, man. Strategy World was great, and I think high signal, and probably in a bear market, just being at a conference around people who are super tapped into the space, I think was definitely alpha for everyone in attendance.
Amen to that. You know who's ever showing up there? They're committed to this in a secular fashion.
Absolutely. So now that IBIT has launched options, at the end of 2024, I think you're the person to kind of tell us what's the volume landscape looking like for crypto options now? What has that done for crypto native platforms like Deribit and other crypto platforms? And how are you utilizing, the ETFs as a tool on your trading desk?
Yeah. So let's use the hackneyed phrase "how the other half lives" or has been living and will live in the future. So when you go to 2020, right? When I first heard about Deribit, and I'd been in Bitcoin a long time, and sort of Deribit as an options market came to my attention. Folks said to me, "Look, there's this space. You got to get involved and start doing institutional market making." I joined Genesis to act as a volatility quant and eventually took over the market making, prop trading, client facing franchise business. Deribit was the market. That was it. I mean, there was nothing else of any consequence. OKX, a teeny weeny, bit, Binance a little, Bybit a little bit, and of course CME options, but CME options not settlable in coin, required cash margining, and not something that was a primary theater of war, for most crypto native participants. Fast forward to today, right, when that was Deribit, 90+% of the volume and OTC flows, such as I managed at Genesis, back to back against Deribit. Now we're in a world where IBIT hasn't just become the tail of the dog. It's the tail wagging the whole dog. Maybe it is the whole dog. IBIT sometime around the middle of last year overtook Deribit in gross open interest and volume metrics in certain facets as, not just the other half, but the primary half. And became the dominant force in options. Not surprising, volumes in trading of the spot Bitcoin ETFs, particularly led by IBIT, BitB, and others, started to be a major catalyst for trading of North American, hours volumes for this asset class. And it went from being the thing that people paid attention to as a derivation of Deribit to the primary venue where people looked to get the marginal indication of volatility surface reality in the Bitcoin options market. And that's a big change. So now let's just call it the half, or I believe slightly more than half when you look at where the future state of the market will be. And then we can talk about how the other half is living. And the other half is Deribit, which is now, I think, in the process of consummating its acquisition by Coinbase. Still a major theater of war, but very different from the days when I was making markets and prop trading at Genesis. There was this thing called Paradigm RFQ. It was an OTC style electronic market maker client taker matching platform where you had both block RFQs inside what was known as the DRFQ, direct RFQ business, where you as a client could RFQ out to one or more dealers, and they had a global RFQ, GRFQ, which was an order book created by a very smart entrepreneur named Anand Gomez. Great tool, really helped bootstrap that business, but it became subject to problems such as toxic maker-taker relationships and high alpha flows, right? Whereby folks that had a sense of where Bitcoin was going directionally next by dint of information asymmetries or proximity to order books or other kinds of information edge, started to trade in large size there. The makers, of course, knew these things. They backed away, and it became, kind of a zero-sum game. And as that happened, other markets like OKX and CME started to get larger, and the OTC market in and of itself became a force of nature. When I joined Genesis, the annualized run rate was probably somewhere around $5 billion of annual crypto options traded. In our biggest year, by the time we wrapped up, we were annualizing at closer to 75 billion in options trading. Now, I'm setting aside linear derivatives, i.e. futures and OTC forwards there, but that's a huge growth, right? 15x essentially over a couple year period. And IBIT has experienced those same kinds of volumes, right? IBIT launched with roughly 10 billion in assets. It's now order of magnitude, right, on the order of 100 billion. Of course, with the decline in Bitcoin prices and IBIT prices, it's less than that potentially on any given day. But indeed, a material surge in options volume has occurred since IBIT launched on January 10th of 2024. IBIT options launched in November of 24, and that's where we are today. I think it's still important to realize that the major unlock between Deribit style, what I call reg light, and that's not to be denigrating, but Deribit has historically not been subject to a tremendous degree of regulation. They were regulated lightly in Panama. They have now set themselves up in the United Arab Emirates and have tried under various regulatory regimes, both VARA, the Virtual Asset Regulatory Authority, as well as ADGM, the Abu Dhabi Global Markets, to kind of get themselves compliant. I actually had a very expensive due diligence undertaken on Deribit when I was at Genesis because, our directors and leaders demanded that we do that. And of course, it's a well-run professional entity, but not the same in its origins or parameters as a CME. So I think we're now seeing that institutional participants want a truly institutional platform. Maybe Deribit comes back to that under the auspices of Coinbase, but we've yet to see how that's going to interact. We don't know what Deribit delivered by Coinbase to a potentially North American customer base will entail. And the reality now, of course, is that if you trade options on IBIT, you can keep it inside an overall securities portfolio. And also, if you trade with a true prime services provider, you can wrap it up into your FCM too. There are plenty of names across the street that are willing to do that for you. And that's very meaningful. And the last and most important unlock is just essentially this year. I think my client base has been some of the earliest adapters earliest adopters and adapters, which is to say taking their Bitcoin, doing an in-kind creation, and turning it into spot Bitcoin ETFs frictionlessly at a spread of as little as 5 basis points, per one-way trip. That's meaningful because heretofore that was potentially classified as a taxable event. This is not tax advice, and I'm not giving tax advice on this call, but most financial professionals that I've talked to since the inception of this frictionless in-kind transfer have effectively said that they don't expect that will cause a tax event for a long-term holder of Bitcoin. Let's say you've held it since $100. You want to turn it into IBIT, reference Bitcoin at $70, $80, $100,000. It's an in-kind transfer, right? Because shares in a spot Bitcoin ETF are equivalent to holding units of Bitcoin. And under U.S. tax law, in their opinion, not my opinion, I don't have an opinion, that's tax-free or taxless. And that means, therefore, that if you had Bitcoin yesterday and the opportunity set in IBIT is better, you can on board with the right counterparty and do that. Why is it meaningful? Well, it's meant that volatility alpha between an exchange like Deribit and an exchange like NASDAQ, where we're trading IBIT options, that spread should tend to compress over time. And we've started to see that. A lot of the alpha and volatility in Q4 of last year for pure Bitcoin vol traders like myself was that spread, right? At one point, IBIT vol was over 10 points above Deribit vol or OTC Bitcoin vol. Why? Because the Bitcoin market was flush with Bitcoin collateral, and the regulated securities options markets and IBIT didn't have enough collateral, and they couldn't get from here to there because there's a bottleneck doing those in-kind creations and redemptions. So it was a neat opportunity, and you could literally watch, as I did, when for my clients, I was trading options for some clients, options on the December 31st IBIT contract and spreading them potentially against the equivalent of OTC 1226 options. And until the 1226 IBIT weekly came on the board, that spread remained in place. And it shows you just how sensitive a risk manager or a collateral oversight guy is going to be in saying, hey, look, you want to run that spread, you're going to have to haircut that risk. So that's now all unlocking. And it's in the process of making IBIT options the dominant place where people are coming for price discovery, seeking liquidity, and looking to implement institutional strategies. That all being said, I still run a healthy portion of my client-facing business on Deribit equivalent prices and Deribit equivalent OTC markets.
Yeah, that's really incredible context, Gordon. And yeah, it just shows like we're, how many 17 years in on Bitcoin, and there's, we're still so early on, I guess kind of the institutional layer being built. And it's crazy to me that last year, there was still, so much arbitrage to be harvested. And I think in Bitcoin, in the larger crypto world, I think there's a lot of vol as well to be harvested in the future. We still saw a 25% move in BTC inside of a week, just barely a month ago. So
That's right.
has the volatility dampened over time, like on the long scale? Obviously it has, but how does that affect how you approach, this asset class that is, still attracting capital because it is so volatile? Is the market maturing something that's, just like super important? And how exciting is it for you that there might be like new contracts to explore or different kind of trades as more products are rolled out? And are you nostalgic for the Wild West days of your crypto trading?
Yeah, well, look, nostalgia is very important, I think, because it gives you a sense of where we've been and where we're going. I don't like to say this in an exclusionary fashion, but if you weren't trading Bitcoin options in 2021, you haven't really seen everything that this market has to bear. And 22, especially, you've seen a little bit if you were there trading options as I was on October 10th of 2025. But there's really nothing to compare to the days where Bitcoin was ripping from 20,000 at the end of December 2020 into the highs at 65 in the spring of 21. I also yearn for those days, not just because of that nostalgic inclination, but also because at that time, implied volatility was roughly 75 to 80 on Bitcoin. The volatility skew for out of the money calls over puts on the 20 or 25 delta risk reversal was closer to 8 or 10 vols, depending on the tenor. It was massive, right? And at some points in time. And the basis was extremely high, right? Analyzing it well over double digits. And so it meant that the opportunities to find vol alpha were a lot easier than they are today, right? So I don't get to sell 100% out of the money 12-month, 9 or 12-month option today for double digit integral percentages of Bitcoin price. Can't do that anymore, right? It's that opportunity set has come and gone, and we have to look for other places to find our alpha. That all being said, right? To quote the great Michael Saylor, there has been a secular compression of both Bitcoin's CAGR, right? It's cumulative annualized growth rate of price appreciation. That's been coming down. We know that. But there has also been a secular compression in Bitcoin volatility, right? From a 75 type level to a 50 type level. And now potentially onward, when you look at something like Bitwise long-term capital markets report for Bitcoin, people, other expert professionals aside from myself, are expecting that Bitcoin implied and realized volatility will get closer on a close-to-close basis. We're not talking about Parkinson's vol necessarily, but getting closer to 30% over time. Now, that being said, right, we tested those levels of 30% implied and realized vol last year. We had massive volatility compression into the third quarter, and lo and behold, it didn't sustain. We saw Bitcoin being that same wild child that it's been, that many of us know and love, going all the way back to the days that I traded my first Bitcoins in 2013. And if you're a believer in data-driven approaches to investing, my gosh, Bitcoin has something in it for almost all of us, and that is 6 out of the last 6 years on which we have identifiable, statistically robust data on Bitcoin derivatives markets. We have seen a significant upswing in Bitcoin implied and realized volatility into the fourth quarter. Why is this? Well, I think that's part of the recipe of the secret sauce of vol traders the world over, but suffice it to say that that is in the data. And once again, in 2025, that proved to be the case. Will history repeat, or will it merely rhyme this year in 2026? We shall see. But the way in which Bitcoin vol picked up suddenly from roughly 30% kind of realized levels, give or take, depending on the time horizon and latency, to suddenly overnight by October 10th, Bitcoin implied vol in the 1-month tenor for October went from roughly 35 to 55, almost 60 overnight on 10/10. That was a huge blowout in vol, and still shows it's not just the level of vol that counts, but it's the level of the variance of volatility. Right? In almost no other asset class do you see implied vol being able to double overnight absent a truly systemic shock, right? VIX vol can do that, but it doesn't happen unless there's a really big war. We're in the midst of one, and VIX hasn't even moved up that much. A specific catalyst like the Volmageddon in early 2018, or something like the global financial crisis, right, where you see implied volatility go from 15 to 50. But to watch the benchmark 1-month at the money implied vol nearly double overnight as a result of things that are unique to that asset, it really puts Bitcoin almost in a league of its own, along with a few other, pretty hairy monsters like silver that I've traded a lot of in my previous non-crypto life, and a lot of silver vol. So yes, nostalgic, but very much looking forward to the future. I do believe that as options markets become more universally integrated, as capital and collateral become fungible, and as trading between those venues becomes increasingly interoperable, we will see that compression in vol. We're seeing volatility elevate right now because of erosion of dealer balance sheet liquidity, right? People have been hurt since October 10th. Bodies, in some cases, have floated to the surface. There have been recognitions of losses, both amongst asset managers, prop traders, and market makers. You can see that in some of the recent earnings reports of players in the space. Marathon Digital's earnings came out. Their asset manager talked about some of the things that have happened to their strategy, and they were not probably as rosy as Marathon had hoped. That ultimately takes away from incremental marginal order book liquidity, and it results in the type of ping ponging that we're seeing. So Bitcoin's still hanging to some of its long, kind of long trud traditions. That being said, right, we are going to move, I think, more towards a gold or other precious metals type of market where it takes a lot to see that asset truly come hinge. It did finally happen for gold, by the way, right? And there was this moment when gold broke through 5,000 recently into the end of last year, when gold vol, which had been treading water around 15 to 17% for quite some time, suddenly went to the 40 to 50 zone, right? So it's not to say that Bitcoin will never become this scary kind of vol monster again, but it's just to say that that time process will be punctuated by fewer large spikes that have further distance in between them, with ultimately a more kind of, I would say, modest crescendo and a reduced peak than we've seen before. And I think that's in keeping with the maturation of the asset. And also, it has to be said, there are products and strategies out there, including mine, that if you multiply them in terms of volume and assets under management considerably, it could lead to a suppression of volatility from historical levels.
Yeah, it makes a lot of sense. That's really cool insider context, and I think something our viewers will really be interested to dive into. There's a lot of threads that popped into mind, and I can only imagine that, like, when you're talking to someone who comes from maybe a traditional finance background, they haven't touched Bitcoin or crypto. I can only imagine how they like think about these insane vol numbers relative to most other assets, other than, like you said, maybe silver's like a closer comparison that you've traded with in the past. So thinking about how gold move and the size of that asset, right? It's an order of magnitude larger than Bitcoin plus, and
Yes,
that gives me hope that we're still gonna there's still room to run, right, for Bitcoin. But
for sure.
talking about the October kind of leverage wipeouts, could we drill down and double click on that? And what's your read as an insider of, was there a catalyst that everyone's kind of missing maybe in the mainstream narrative? But I think your insider perspective on that would be great.
Yeah, look, I can say that I've done a lot of homework to try to unpack what occurred on October 10th and subsequent to that, because it's not just a one-day event. There have been openly acknowledged losses among some household names in the crypto alternative investment manager and prop trader space. They don't need to be named on this call. There have also been some openly acknowledged large losses within the market maker community. Um, many of which have been well digested by household names. I think the real open question is, what about some of the speculative discussion about these single asset SPVs that may have been based out of the Asia Pacific region that were taking leveraged, large directional bets on IBIT or just Bitcoin in its entirety, potentially using regulated derivatives markets? That, I think, is the sort of the X factor that's yet to be determined. There have been some great discussions about this as to the extent to which those may have driven Bitcoin pricing action, and some folks have speculated that, well, perhaps there was a let's say, imagine a systematic trend following strategy that built up significant length in Bitcoin over the course of most of 2025, and it continued to add that incremental length into fresh all-time highs as enthusiasm for the digital asset treasury phenomenon, hit its crescendo, and as expectations around Bitcoin becoming this institutional asset, really, really took hold. And then onwards from 1010, that type of position may have become compromised. And if it did, that may have resulted in the type of heavily offered on rallies price action that we saw in Bitcoin that began on October 10th, right? We saw that one day 20K candle from 122-ish down to 102, big bounce back to 115, high vol, high volume. But it was really the beginning of the end there for kind of the Bitcoin bull run, and we saw this steady cascade lower where any rally was sold into. And interestingly, in that time, and this is still an open question for me, I don't have enough data yet to verify it, we saw precious metals start to take their historic surge higher, right? So gold had been kind of incrementally moving upwards through much of the year, silver as well, but they had gotten to levels that were kind of at a stasis, right? Gold got up to about 3,000, 3,500 and had been, ping-ponging around there. Silver had gotten up to its old nominal all-time highs of 50. And then all of a sudden in Q4, they absolutely took off on a moonshot. As did some HPC, high performance computing and data center players, while Bitcoin was languishing. And it was very hard to understand for most folks. It almost seemed as though there was a factor rotation going on. And the telltale for me was that as we got into the end of the year and then finally that kind of cathartic meltdown in Bitcoin from roughly 90,000 to 60,000, just as January was coming to a close, we saw implied volatility in other assets go absolutely berserk in a way that suggested cross-asset contagion. We saw silver have a one-day, roughly 40% candle. Never happened in the history of the asset. Silver traded 125 basis, COMEX prompt contracts and all the way down to almost 75. An insane move, right? Implied volatility well into the triple digits, a type of liquidation that appeared to be well out of scope of what's been seen before. We saw implied volatility in HPC and Bitcoin miner proxy names like Iris Energy at 500% going into the Feb 6 expiry. That's a 500%. Markets don't get to 500% implied vol unless they're not working. 500% vol doesn't mean that it's actually monetizing there. It's irrelevant. It means that at that point, someone is getting body bagged and carted out. Who? We don't know yet. But it suggests when we put the pieces together between successive downward pressure in this cascading Bitcoin sell-off, a sudden sharp reversal in these bull precious metal trends, a spike in implied volatility, and contamination even to correlated proxies, tells you that probably both between market makers, prop traders, asset managers and large individuals, there may have been something going on there. And that's what I think best describes the phenomenon that we've seen. That doesn't mean that that's the complete and comprehensive picture. Obviously, if you talk to a pure play technician and a longtime markets guru like a Tom Lee at Bitminer or Tom DeMark, who's been one of his technical analysts and I think has been a leader in that space, they would just say, hey, listen, this was a key inflection point in markets. They happen, right? Markets make tops when the last person pays the high and you have complete, buyer demand saturation, and there's nothing more to it than that. But I'm a bit more into the weeds in terms of what's the microstructure of the market, what's that topography across these heterogeneous assets that would have led to the setup like this. And I think the last and important thing to note, right, when I look at the behavior, and for me this was the most significant being a vol watcher, if you paid attention to the relationship between Bitcoin spot returns and Bitcoin implied volatility movements, there was a massive shift in that realized and implied correlation on or about mid-August of last year. It had been persistently positive for quite a long period of time, especially through the bull run. It's what we call a spot up, vol up bull regime, much like precious metals have tended to see. Spot goes up, people buy calls, spot goes up more, the gamma starts to run, dealers have to cover, and so on and so forth. All of a sudden, that correlation started to become negative in mid-August, even as Bitcoin moved back toward nominal new all-time highs. And when Bitcoin got to 126,000 on October 7th, after hitting, that historic level and beginning that rally from 110,000-ish on September 30th, volatility was flat to down throughout that move, which was amazing because the government was shutting down at that point. It was actually an environment in which other assets were starting to move upward in a pretty violent fashion. And there's Bitcoin vol going down as spot is making new all-time highs. It was really one of those ring the bell moments where you got a sense as to what was going on under the surface, right? There are some people that believe you can predict all kinds of weather phenomena based on what's going on below the surface of the ocean. And there's increasingly good scientific evidence that this is the case. I liken what I do in volatility markets to being one of these kind of oceanographic, meteorological, catastrophic forecasters, at least as part of my job, where I think about those undercurrents and what are they telling us. Now, why might have that happened? Well, it could have had to do with where the relative pockets of supply and demand of implied volatility were in the Bitcoin options market. Bitcoin continued to make new highs. People that ran programmatic overwriting or call selling strategies, people that run tactical volatility strategies like me, might have been using the opportunity to sell volatility as Bitcoin rallied. They go, hey, look, Bitcoin's making new highs. If you want to take me out of my Bitcoin at 120 or 130,000, bless you. Take it away from me. And so we continue to see this relentless supply of volatility from the market and slide on dealer books. But what was the contra to that? Dealers were gagging on implied vol. There was almost no bid for out of the money call options as we got into that, first week of October and the beginning of that cyclical upswing in volatility. So if you needed to lay off the vol you were getting given, right, as a dealer, you have to understand you can't just warehouse risk infinitely. And as the supply of calls continued to grow and as the slide into that gamma saturated dealer books, in order to neutralize their volatility, they only had one choice: sell vol on the other side of the surface. That means the left tail. And that's exactly consistent with the type of washouts that we saw on October 10th, where we had a sudden gamma flip, where the market was saturated, gills long upside gamma in Bitcoin, but probably significantly short in that left-hand tail. And that's what in part led to that sudden gap move down, that 20K one-day candle in BTC. And those are the things that I think also at a micro level, right? You've got that macro story about precious metals, Bitcoin, single asset funds in APAC, a big unwind, a rotation into other things, vol and, Iris Energy and silver blowing up. But really underneath that kind of texture, I think, is important to pay attention to as well. And I think taken together comprehensively, they can help us understand to a certain degree what was happening in that October period.
Yeah, those are really cool narratives, and like I said, it's it's super amazing to kind of get your insider take on this. And I think a mistake that I made just as a retail trader, kind of learning some options as I held on to the bullish vol sentiment a little bit too long. When you see a trade that works, it's hard to jump off the train. I want to double click on risk management in a second, but just thinking about like back to the spot market, so at the end of 2024, we had the elections in the United States. The Trump administration, as soon as they looked poised to win on election night, we saw prediction markets and Bitcoin price kind of lead the way before legacy media was calling the election. I think they're really conservative in the way they model these things, but that it is cool to see Bitcoin's price kind of react, just knowing that the regulatory environment was going to be changing. Just from an amateur perspective, looking at like on-chain analytics for Bitcoin, when we blew through, that 60, 70K price range, I was like, okay, there's like an air pocket here in the spot price. It's like, we're going to come back and test this, was like my baseline thesis. And, through into the next year, through the summer, of course, I was following Bitcoin Treasuries really closely and probably got caught up in a little bit of the exuberance. I thought we were setting, kind of a new floor. And I'm like, okay, I guess maybe we don't have to go back and test this air pocket. But as we're all well aware, we're back down there now. So,
Yeah.
I guess a question I have to you is how, Bitcoin is different than traditional markets, and how much do you use analytics on chain in your work? Like, is it kind of the baseline thing you're looking at, or is it more of a Black-Scholes type of approach? Traditional options and derivatives. How do you use on chain analytics, and where is the smart money in that space?
I'm going to use a technical expression and then I'm going to unpack it. On-chain analytics can potentially be incorporated as a Bayesian prior, one amongst an assembly of Bayesian priors, an ensemble approach, if you will, that may have statistically robust information ratios, i.e., a significant amount of signal versus the noise in the inherent machine, the system that is Bitcoin. It doesn't mean that they're always meaningful, but they can be meaningful. What was meaningful about on-chain analytics? Very aged wallet selling of Bitcoin. Those guys came alive with Bitcoin in the triple digits. I think one of the surest things that if you were holding Bitcoin in the triple digits and didn't sell, as many folks did, and you shouldn't fault yourself in an emotional or psychological way, but the signs were all there. Whales were deaccumulating, right? And people were going, well, DATs are going to take it, and DATs never need to sell Bitcoin. Well, why not? And so people ignored the very obvious sign that someone who held Bitcoin since it was $1,000 or less and is now taking billions off the table, and they're giving it to someone who hasn't held it since it was $1,000 or less and has to market, didn't think about the psychological dynamics of that tape, right? And so when you look at a basic on-chain metric, the profit or loss percentage of the network, I think it's meaningful sometimes, right? I think other things such as what are whales doing, sometimes meaningful. Sometimes that might be just basis trading, right? So for instance, if I told you the basis was negative in the midst of a major sell-off and whales who are not getting out of the trade had the opportunity to sell Bitcoin spot and buy Bitcoin futures at a negative basis underneath where spot is, well, they're not getting out of Bitcoin. They're just rotating. So your on-chain metrics could be a red herring there. You might go, oh my gosh, whales are selling. I have no doubt during the beginning of the regional banking crisis in March of 2023, if you looked at on-chain metrics, you would have seen some large wallets selling Bitcoin. But if you had been able to see what was going on over-the-counter and listed futures markets, you also would have seen a number of significant buys of negative basis futures contracts at the same time. Heck, I know because we were doing some of that in my former life at Genesis. If you had Bitcoin, why would you hold a delta one directional position without taking advantage of that market distress and that funding arbitrage? So it's not always the case that you can incorporate it, but you should think about it and potentially make a decision on it. Obviously, there are other examples, right, where on-chain analytics providers have been able to convey alpha to market participants by citing government wallets. Right? That was a big thing. Some of the on-chain analytics providers highlighted when the U.S. government under Joe Biden began to sell some of the Bitcoin that it had held from the U.S. seized Marshall's Bitcoin or the DOJ Bitcoin, and people keyed in on that. People also keyed in on the German municipal government selling of Bitcoin in the summer of 2024, prior to the election. People were aware of this phenomenon and watching them as they ham-fistedly dumped large quantities of Bitcoin into exchange order books. Helpful for sure in understanding what's going on. Surely not the only metric that matters, but one that can matter just insofar as technical indicators can matter, right? I'm not a technical guru again like a Tom Lee or a Tom DeMark, but those things also could form part of a valid statistically significant conditional prior, in this fashion. Right, you do the TD indicator to see where there's a pivot point in the market. I think it also matters even in a situation like today where the key technical moving averages for Bitcoin, the simple moving averages, whether they're daily moving averages or weekly moving averages, they're so far above where the market is. It could be bearish because any rally you get people selling to, or it could be bullish because it could set us up for a massive squeeze back up to one of those levels, right? There's been some good discourse over the last 24 hours when you read the tape. TradingView published an article and they quoted two Anons, Crypto Candy, and I think his name was Donnie Dean. And Donnie Dean said that Bitcoin could squeeze up to 90K. And Crypto Candy said that until the market breaks above 70, it's going to see technical resistance at that level as we see continued deaccumulation from miners and other participants. All those things do matter. The question is, what's your alpha? I think if your alpha is directionally timing the market, you really need to pay attention to that panoply of factors. If your alpha is something else, then it could be less important to you, right? Because the thing that's implicit in what I said about a Bayesian prior means the amount of information that we incorporate into mapping a probability distribution, saying conditional on knowing this, what do I think that bell curve, or not bell curve, that highly skewed distribution looks like? And sometimes, depending on your decision function, on-chain analytics could matter much more than other decision-making functions, is what I'm trying to say.
Yeah. Yeah, that's really good context, and I do want to tap into what Bitwise can offer some of our viewers in Bitcoin Treasuries. But before that, I've got kind of just one more question about like the both risk management and kind of the great de-risking of Bitcoin. Like you said, all the fundamentals have kind of lined up with the ETFs being approved over the last couple of years. You had FASB accounting changes, which impacted treasury companies. You've got a regulatory environment that's much more fertile and open to crypto broadly. And there's only so many times Bitcoin can die and come back before traditional finance is just like, okay, we've got to take this more and more seriously each successive market. But I know you've seen lots of highs, lots of lows, and maybe some frustration through consolidations in the past. But how do you look at the great kind of de-risking of Bitcoin as maybe a serious global macro asset, and then secondarily on that risk management perspective, famously in the last market, we had, a lot of contagion that we've touched on earlier in this conversation. You had Terra Luna, which kind of fed into the fall of Three Arrows Capital, and Alameda, blew up. So how as someone who's trading derivatives, how do you view risk management in the space when, at least from my chair, there's much more of a black box, I would say, than traditional finance markets? That's not to say we saw you came up during the great financial crisis. So, I mean, risk management was on the sidelines during, maybe the housing bubble and the packaging of toxic assets. But how do you think about those two things, both the de-risking and risk management from a portfolio perspective?
Yeah, well, there's clearly still some de-risking potentially in the wings. Why? Again, I'm citing Marathon Digital's earnings reports where they have signaled a shift in their policy and a willingness to deaccumulate their Bitcoin. It's been publicly announced that other folks in the mining community that have long holded their Bitcoin are willing to sell it down for general corporate expenditures, perhaps to get into data center businesses and high performance computing, or just to manage risk. So the narrative around hodl or die, diamond hands, perhaps has been a bit diluted, in terms of its overall enthusiasm. Doesn't change the fact that, as Michael Saylor often says when he talks about the merits of his stretch product, unless you believe Bitcoin is going back to, a very low number, i.e. below 10,000, there's a bright future for this asset class. There's a bright future for assets that are predicated on that type of thesis, including, the products that he peddles, distributes and creates. But that's a point-to-point observation, right? He's essentially saying a product like Stretch is sufficiently well collateralized given MicroStrategy's balance sheet as long as Bitcoin stays above, pick some number, 10,000. It's actually a bit less than that according to his calculations. But what happens in between? And what kind of strategy are you running? So for instance, could a player like Tether that holds a lot of Bitcoin have to exercise risk management if Bitcoin were to go down to that level? I don't know. There are some people that claim that Tether might actually have to do that, right? What if gold went back to $2,000 an ounce? Some people say gold's never going back there, but what if it did? Risk management is often a question of not will you do it or will you have to do it, but is it necessary if such another thing occurs? And that appears to have been a question that once again this cycle many people didn't ask. Clients of mine did some amazing principal protection strategies at various points along Bitcoin's bull run and its retracement. If you can believe it, I had a client that was putting on June 105,000 put, 175,000 call collars when Bitcoin was 120,000. Smart guy, maybe a smart advisor. We'll see. But there are other folks that didn't think about risk mitigation or principal protection until Bitcoin got down to 60,000. Is it too late? Well, it's never too late to manage risk. It just might be not profitable to do so. And therefore, I think that there's clearly been a large amount of de-risking. You've seen gold go to $5,000 an ounce and Bitcoin fall by 52% from the highs. If you believe that Bitcoin is global digital capital, and I believe today more than ever, it is likely to fulfill that promise as a result of those regulatory changes and the advancements and the unification of collateral and the cross-venue fungibility and the cross-asset operability that we're talking about, Bitcoin is doing amazing stuff. I still say today, as a former precious metals player, take your gold bars and go trade an over-the-counter options contract in gold and show up with your bars and post them to your friendly FCM and say, hey guys, I don't want to post cash margin. Just take my gold. They're going to tell you, dude, take a hike. Doesn't work that way. You still need the good old US dollar per Uncle Sam's requirements. Bitcoin is almost the only asset in the world where you can show up and trade a derivatives contract and just straight line that Bitcoin into the collateral for the contract, settle the premiums in the asset, sweep it back to you, and do the whole thing in this native unit. Gold might get there when gold finally gets on chain, as my other metals, and I think that that's a very interesting phenomenon. But as it stands today, Bitcoin is still the only 24/7, highly liquid, heterogeneous market for spot, futures, and options. That's really special. You can borrow fiat against it. You can borrow other cryptocurrencies. You can trade it both on chain. You can trade it over the counter. You can trade it in any number of facets. You can increasingly involve yourselves in all kinds of esoteric Bitcoin staking. It has all those things going for it, and none of those has been diminished by Bitcoin selling off. So I think that the de-risking that has happened has brought on some amount of forced risk management. Right. And I don't mean to keep singling out Marathon. I'm just mentioning it because it's happened today. They're such a large holder, right? They're the second largest holder amongst publicly traded players as it stands today. And they're making a decision to talk about doing something different. Marathon, not so long ago, was borrowing dollars from convertible bonds to do, amongst other things, buy Bitcoin, at least per their publicly, made representations, such as I understand them. Was a good trade for a while. Maybe it's not such a good trade. Maybe it'll be a good trade in the future. But they're deciding to potentially expose themselves to a de-risking discussion. And that is responsible risk management. Risk management means, in some ways, looking ahead and understanding what could happen that would force you to take decisions and prepare yourselves preemptively. Risk management can also mean addressing unforeseen or otherwise unpredicted factors and taking action ex post. Both of them can be good. Both of them can be unprofitable. Right? It's a broader discussion. But what I will say is that there's a growing portion of the Bitcoin market that to me feels more institutional and more inclined to have a serious discussion about risk management in the midst of this de-risking. No surprise, but my chats and phone have been ringing off the hook relatively more than they were when Bitcoin was at all-time highs. Why? Because my strategy is about generating static return. Some people would call it yield. I don't call it yield because I don't want to misrepresent what it is. It's not a coupon. It's not a bond, but generating an uncorrelated revenue stream that can be monetized from the asset in the event that the asset doesn't do anything over a long period of time, and trying to work very rigorously to provide the full price participation in the asset, which I'm happy to report for representative accounts that I've managed over a multi-year period has been the case. But the fact of the matter is today, as Bitcoin broaches 69,000 again, the market loves these fancy numbers. Bitcoin hit 69,000 for the first time in October of 2021. Bitcoin today is 69,000. What did you do between then and now? Risk management doesn't always mean taking out crash protection insurance. Risk management can be something that you do every day to ask, how productive are you making your own capital? And I think that that is starting to factor itself into the mix and is a true sign of institutionalization.
Absolutely. We're running up against our time here. Great discussion from you, Gordon, and really appreciate both the high level discussion and digging into some of the details here. As we're wrapping, what services do you offer at Bitwise that viewers might find interesting? What can a Bitcoin treasury do that you guys might be able to help out with, and where can our viewers follow you online?
Yeah, well, look, first of all, this is not a recommendation to or a solicitation to buy or sell securities or to trade a commodity or a commodity contract of any given type. But Bitwise, as a RIA, registered investment advisor, as a CTA, commodity trading advisor, and as a CPO, commodity pool operator, is able to offer to accredited institutional clients, not for retail, at least not for the purposes of this discussion at this point in time, but for those institutionally accredited investors, Bitcoin treasuries, if you will, it is able to help them devise a strategy that is predicated on trading options under the advisement of myself as a portfolio manager to create uncorrelated revenue streams that are derived from trading options collateralized by the Bitcoin. That's a key premise of it. And that strategy really is what you can think of as a flagship or a core pillar. It can also include principal protection, both passive and active. It can include risk recycling or diversification. If you have only Bitcoin, maybe you want to get into other digital assets. Maybe you have Bitcoin but want to get into trading options on IBIT. That's another form of what I think of as venue diversification. You can think about broadening your scope of counterparties. You can also think about increasing your risk tolerance. For the most part, the flagship strategies that I oversee don't use economic leverage. They only take the notional amount of Bitcoin that they hold as the total net notional exposure that they can enter into. But there's no reason you couldn't add leverage if you didn't want to. So all of those are things that, as an institutional money manager, Bitwise is capable of doing. It really depends on the preferences and risk tolerances and objectives of the client, which is what you should hopefully hear from any responsible asset manager who is going to talk to you about what it's going to do for, let's say you, Bitcoin Treasury.xyz. Not every treasury, not every DAT, not every publicly traded company that holds Bitcoin, not every family office, whale, OG, holder, diamond hand, Bitcoin celebrity is the same. And their objectives may be as simple as stacking more Bitcoin using their Bitcoin. That's the true maximalist approach. Some may be pulling cash, fiat, out of that without having to sell it or borrow money against it. Some may be thinking about putting a floor under the price of their Bitcoin for any number of reasons and stacking some on the side. It could be any number of those. But the key facet here is finding alpha from the options markets run by an institutional money manager that's been doing this just about longer than anyone else in the game.
Good stuff, Gordon. Really appreciate you. And one thing we have all our guests say before they leave is stay orange.
Stay orange. I like that. That's good. You know what? Next time I come on, I'm going to wear my orange necktie like Michael or an orange bow tie, and we can have a little more fun. Or some orange garb. I was just too conventional with my green sweater.
Ladies and gentlemen, the guy who's been one of the biggest trailblazers in the new wave of derivatives markets, but is so down to earth he can talk about it to your grandma, Gordon Grant.